Hi, this is Wayne Zell, and we were just talking with a real estate expert on Blueprint for Wealth. And one of the tools in the real estate world that doesn't get enough attention and should is the issue of dealing with like-kind exchanges. So I'm going to give you a few tidbits on like-kind exchanges because you should have that in your tool chest if you're looking at becoming a real estate investor. What's a like-kind exchange? Let me give you an overview. We'll talk about it. How does it work? What are some of the special considerations with like-kind exchanges, and when does it work and when does it not work? What are the advantages and disadvantages? Well, it's a technique where people can basically swap property, exchange property, and not have to pay income tax on the sale or exchange of the first property. So you can sell a property and replace it within a specified time period and not pay income tax until you ultimately sell the last property. So dispose of one piece of real estate, acquire another one. After 2017, note, like-kind exchange rules only allow you to do this with real estate. You can't do it anymore with a business or intangible assets. How does it work? Well, when you sell a piece of real estate, you normally have to pay tax, capital gains tax, on the sale. And if you had depreciation on the real estate, you have to pay depreciation recapture or ordinary income tax on that, which ranges in rates all the way up to 37%. The capital gains top rate is 20%, and you have to have held the property for more than 12 months. Section 1031 of the Internal Revenue Code allows you as a taxpayer to defer income tax on the sale of real estate if you reinvest the proceeds into similar property that has a value at least equal to what you sold. So if you get cash in addition to the replacement real estate, you're going to have to pay tax on it. That's known as cash or boot. And it does not allow you to do this with personal residences unless you converted it into a rental property. But the key is you have to identify the replacement property within 45 days of selling the first property. You have to purchase the replacement property within 180 days of the sale. You could actually identify the replacement property first and then sell the property that you wanted to replace it with. It doesn't have to be in exactly the same order. So it allows you to defer ordinary income tax that otherwise might be incurred because of depreciation recapture. And if you follow the state rules, you may be able to achieve exemption from state income tax. Often, it's good to use a qualified intermediary, somebody who specializes in only handling like-kind exchanges, usually a real estate lawyer, that provides this service for a reasonable fee, and it's worth it, believe me. The advantages, of course, are income tax deferral. And if you hold on to the replacement properties, and there's no limit on the number of like-kind exchanges you can do. You can keep rolling over property one after another. And as the value increases, obviously there's going to be a difference between the value and what you originally paid for the original property. So there may be a huge gain. If you die holding that replacement property, you get to step up the fair market value, the basis, to fair market value, so that there will be no capital gain if your heirs sell the replacement property after you die. There's no limit on the number of transactions, but you've got to follow the rules. There's specific forms that have to be followed, and you have to meet the deadlines, the 45-day and the 180-day period. Also, losses are deferred, and they're lost if you die holding property with a loss built into it. So that's just a little bit about like-kind exchanges. It'll help you in your real estate investment practice, and use it as a tool in your quiver to build your blueprint for wealth. I'm Wayne Zell. Have a great week.